The chief economist of Goldman Sachs here in India, Prachi Mishra. She came out with a note recently, last evening, in fact, warning that the growth in India could fall to multi-decade lows. Prachi, very good afternoon to you, and thank you very much for taking time out for us today and coming on the show. Very interesting note, one of the most, cautioning and warning notes we've really read in recent times. Which makes a case that the growth may fall sub 2%. What are the indicators you are looking at which have turned green to amber or even perhaps red, which is leading to that kind of a dire forecast?
Thank you, Ajay. Pleasure to talk to you. So let me get started perhaps with our outlook for the global economy, because that's an important input for our forecast for the Indian economy. So if we flash back a little bit, earlier during the year, we were relatively optimistic about the global economy. Our global growth forecast for 2020 was 3.25%. And our view was that, the global economy would be better in 2020, supported by easier financial conditions and an end to US-China trade war escalation. Since then, however, our global view has changed completely. We've revised our global growth projections down sharply by more than 5 percentage points relative to a pre-virus situation. So our current global growth forecast for 2020 is minus 2%. And just to give you a sense of what the numbers look like for particular countries, for the United States and for the Euro area, we have minus 6% and minus 9% respectively for 2020. And if you look at quarterly numbers, for the United States, we have a forecast of a 34% contraction in the level of real output in Q2 of 2020. So let me then come to India based on what the global economy would look like. And let me say that on India, relative to early March, when the virus situation was fairly benign in India, we have revised down our growth forecast dramatically. Pre-virus, our forecast was closer to 6%, in fact 5.8% for fiscal year 2021, which is the fiscal year from April 2020 to March 21. Now we are at 1.6%, as you pointed out as well. This is a gigantic 420 basis point downgrade. Elaborate a bit on, three key reasons for this sharp downgrade compared to the pre-virus situation. Number one, I think given that, as I said, we've revised our global growth projections down by more than 5 percentage points relative to a pre-virus situation, this would definitely have implications for India growth. And using elasticities of how much India growth would react to global growth using historical data, which we've estimated, this would be a roughly 150 basis point downgrade for India growth. Number two, I think what these forecasts do, Ajay, is they take into account directly the effect of the lockdown. So currently we are in week 3. We are basically assuming 25% of the activity would be wiped out in these 3 weeks. And in addition, we are assuming, as seems to be the case now, that there would be a staggered exit from the lockdown, as seems to be the recent thinking. So this, if you take into account the fact that, at least 25% of the activity would be wiped out during these 3 weeks, and in addition, some sort of a staggered exit from the lockdown, this would amount to roughly around a 220 basis point reduction in growth. And number three, we account for some additional spillover effects on investment over.
Prachi, let me just interrupt you just a bit over there. We'll take those points bit by bit. Let's break it up. Let's go back to that point which you were making, that this comes in a global backdrop of economic activity shrinking. Before we could break those points up, I would like to know the two biggest engines of global growth so far, in your view, or your numbers are showing, which is US and China. How badly are they hit, and what do you see the roadmap for them recovering? Because we would be, following that route as well. Then we'll come to India factors.
Sure. Ajay, as I said, for the United States, in annual average terms, we have a forecast of -6%. And in fact, in Q2, just think about these numbers, 34% contraction in real activity in the US in Q2. So these are huge numbers. Similarly, I think across most countries, we actually have sharp quarterly contractions, quarter on quarter reduction in the level of real GDP in both Q1 and Q2.
Sure. Okay, let's come back, Prachi, to and analyze the policy action. We know this is unprecedented economic challenges which the world faces, and we cannot be immune to this. How have you analyzed the policy measures and the global central banks what kind of room do they have? Because this is originally a health crisis which is blowing up into an economic crisis. How have you analyzed or compared China's actions, US central banks and policymakers, and how do we as a country stack, though we have just rolled out half of it, some more is expected?
Right. Ajay, as you correctly pointed out, this is truly an unprecedented shock globally and for the Indian economy. And if you think about it, one key difference vis-a-vis some of the earlier episodes is this whole fear and scare factor among citizens around the world was clearly not, was not prevalent at all in any of the previous recession episodes. The COVID-19 crisis, or more precise, response to that crisis. How are you dealing with that crisis? You're basically, imposing lockdown, social distancing. The response to the crisis represents a physical constraint on economic activity, which is different from, say, a financial crisis where there's a shock to the financial sector. This kind of a shock is truly unprecedented in post-war history. And whenever the constraint is physical, you actually see sharp contractions in economic activity, which you're seeing across the world, and we forecast it to be the same in Q2 as well. And now coming to your question on, policy responses. Given that the shock is unprecedented, policy responses need to be unprecedented too. And, this is a global health pandemic. So the first line of defense has to be to contain the spread of the virus and to deal with the infected population. And if you come to India now, both the center and the state governments have been fairly proactive from the start and taken a number of steps in terms of screening people, closing borders, the nationwide lockdown since March 24th, and which is likely to exit most likely in a staggered fashions. And going forward, we expect more measures to come. See, macroeconomic policy, whether it's fiscal policy, monetary policy, in a crisis like this, it can only be a second line of defense. If you come to monetary policy, of course, global central banks, but even in India, the RBI has cut interest rates by 75 basis points ahead of its scheduled MPC meet and has taken a number of liquidity infusion measures. We do expect that, going forward, there would be more rate reductions, especially we have built in 50 basis points more by the end of Q3. And this is due to three main reasons. If you look at the central bank's response, number one, I think headline inflation is likely to come down. Number two, I think risks to our growth forecast, despite these sharp downgrades, actually remain to the downside. And third, if you look at the RBI's forward guidance provided during the governor's press briefing last time, it does suggest space for further action as well. So let me come to the second pillar of macroeconomic policy, which is fiscal policy. And there, I think, lot of discussion that India does not have much fiscal space, how much fiscal response should be there. And there, I think, we've been saying this for a while. Clearly, I think if you look at public sector deficit net of asset sales, for India, it's close to 10% of GDP, and it remains the highest among emerging economies. So no question about that. What is important to note, however, at this point, that these are more medium to long-term arguments. Right now, the economy is facing a globally unprecedented shock. And the lack of fiscal space perhaps implies, and that leads to, that answers your question as well, that India perhaps cannot have a fiscal response of 10 to 15% of GDP like many advanced economies have done. However, I think what I would like to stress in the Indian context is that, rather than focusing on sheer magnitudes, I think what market participants are looking for is more, whether the fiscal response is temporary, it's targeted, whether it's carefully calibrated and it's properly executed.
Prachi, this is also a time that almost everybody is going back to their textbooks, going back to economic history and trying to find out how have economies worldwide, come back from deep recessions. What does your study say? How exactly does it happen? How much time does rebuilding of shaken structures of economy actually take? How do large corporates and economy work together? Give us some instances, what exactly the model of rebuilding the world or even India.
Look, Ajay, let me say that, each economy's experience is different, depending on what the initial conditions were, depending on how the institutional structure is. In this case, how the public health system is. So I think it's not apples and apples to compare, across economies, because they differ in a number of ways. The policy responses differ, the thinking differs. What I can say here is that, in the case of India, the average of 1.6%, which you might think that, it's a really low number, actually assumes a strong sequential recovery in the second half of the fiscal year. And this is based basically on three assumptions. Number one, I think the 3-week nation lockdown, which is expected to be removed rather sequentially, and social distancing measures actually reduce new infections over the next 4 to 6 weeks. Number two, I think while the fiscal easing so far has been limited, our expectation, and so is the market expectation, of further fiscal stimulus by the central government as well as the states. I think a package for the small and medium corporates, for example, is under discussion. And number three, I think for the central bank to continue with its monetary easing policy along with liquidity infusion measures. So just to summarize, and to be clear that, look, 1.6% looks a really low number, and in fact is one of the deepest if you compare to India's previous quote-unquote recession episodes. But remember that given the trough in Q1 and Q2, given that you are going to have a contraction in output in Q1 and Q2 of this year, a number like 1.6% would actually require a strong sequential recovery in the second half of the fiscal year.
Right. All right, Prachi, I'm afraid we'll have to let you go on that one. I would have loved to have this interaction slightly longer. It was just starting to get much more interesting. But thank you so much for taking time out for us today. I look forward to having more often chats with you on the channel. Goodbye. Thank you very much.